Welcome to the Power and Market Report on the Sprott Media Network. I'm your host, Albert Liu. Glad to be joined today once again by Christopher Whalen. He's an investment banker and author who lives in New York City. He's also the chairman of Whalen Global Advisors, LLC, and works as a consultant and analyst focused on the financial services, mortgage, finance, and related technology companies. His latest book is titled Ford Men: From Inspiration to Enterprise. It's a study of Ford Motor Company and the Ford family that spans the history of the 20th century America. Chris, thank you very much for joining me once again on the Power and Market Report. How are you?
I'm doing great, Albert. Thank you for having me again.
You're very welcome. Thank you for coming on. Congratulations on the book, which launches on April 11th. It's available for pre-order now. On Amazon, I noticed, so congratulations on that. And also, I want to thank you for agreeing to participate in the Vancouver Natural Resource Symposium this summer on July 25th as a speaker. Very happy to welcome you to the roster of the symposium as well.
Yes, indeed. It should be a lot of fun.
So if you want to see, to the viewers, if you want to see James Rickards, if you want to see Chris Whalen, please go to naturalresourcesymposium.com. Sign up. Early registration will save you hundreds of dollars and also will give you access to the MP3 files from last year. Chris, we had a very insightful discussion last time you were on. This was just prior to the elections, I believe, back in September, about banks and real estate. So I just want to sort of bookend that discussion on banks with your thoughts on what's going on right now. I remember I went over my notes from our last conversation. You thought that banks maybe could get to low double-digit return on capital. And this month we've had a lot of, I guess, things going on. And I'm thinking particularly about Deutsche Bank and Credit Suisse. It just continues. So the cost cutting is sort of what we focused on last time. And it seems like nothing's changed. There's still cost cutting very aggressively. But the problem with Deutsche Bank in particular, or Credit Suisse as well, is that to get their capital ratios up, they have to keep issuing. So it doesn't seem to be benefiting the investors. So what is your outlook on the big banks right now?
European banks are in trouble because Europe is in trouble. They don't tend to make a lot of money. And as you pointed out, they are consuming capital. They're not building capital. The credit situation in Europe is problematic. It's very difficult to go out and collect on a bad loan or seize a building or a piece of collateral because the courts are very debtor-friendly. They don't have independent bankruptcy courts in Europe. So it's a mess. And I think it's illustrated by the fact that the guy who made a mess of the Italian banking system, Mario Draghi, is now the head of the European Central Bank. And his big idea is that we should bail out the banks. So I'm very cautious on European institutions, the regulatory framework, the economy, just the overall situation facing all of these entities, big and small, is really quite problematic. You know, the biggest names, Santander, BNP Paribas, they're going to survive, but only because they're basically sovereign credits now. The governments stand behind them. Deutsche Bank is problematic because it's not a bank, it's a hedge fund. It's based in London. It reflects the legacy of Merrill Lynch and Bankers Trust and various other organizations where they took people or businesses over the years. And it just doesn't work. It doesn't function as a bank in Germany. It's basically a big trading platform. And I think much like Citibank, ironically, it doesn't have a very strong business case right now. There's no reason for this bank to exist anymore. That's just the short version.
I was reading an article on the Financial Times reporting there about Deutsche Bank, and so they're at 6.5% return on tangible equity. The story,
Yes.
as you say, is not good, but they had someone who had purchased some of those Cocos bonds. Remember when the bottom seemed to be falling out?
What a great
purchased.
idea.
Yeah, well, 70 cents on the dollar, and they seem to be doing okay. So what do you think about as a bond guy, the idea that the business looking forward does not look great, but these are still safe credits?
Well, I've taken that position with Deutsche in the past, And I wouldn't change it because ultimately the government of Germany, despite what Angela Merkel said previously, would have to back up the bank. They couldn't let it go because the contagion that would occur would be rather dramatic. Now, having said that, the Europeans are getting to the point in economic and financial terms where they almost have to start thinking about haircutting bondholders, which means they might convert them into equity, they might pay them some of the money they owe them, but not all, because Europe is in what we call the tertiary stage of finance. They can barely afford to make interest payments, and they certainly can't pay back debt. The principal has to be rolled. So the banks in the same way, I mean, if they make money at all, their equity returns are single digit. But the cost of capital for these banks is 12, 15%. So obviously they're losing money. I mean, it's like a global automaker, another great industry, right? These are industries where competition, state subsidies, all of the factors you can think of all combine to make it hard for them to make money. And in Europe, the big problem is they just don't have a lot of good customers, especially business customers. There's a lot of regulation, much more than in the U.S. U.S. banks are pretty solid because we force them to resolve bad debts quickly. That's the great strength of the U.S. economy is the fact that we have a bankruptcy process, the fact that we don't tolerate insolvencies. It really helps banks clean up the mess quickly, and that's what they do.
Now, we've been seeing, like I said, cost cutting going on for an extended period. Seems like they're cutting industry to the bone now.
Yeah, that's U.S. banks, European banks. The lift in earnings has come from cost cutting. Pete Najarian, his good friend of mine, was beating me up on CNBC last week. But the earnings were so good, Chris. They were up 8%. Okay, but that was cost cutting. That was one-time events. That was revaluing the mortgage servicing rights, which we're going to mark down this quarter, by the way. So there are a lot of bells and whistles that a big bank CFO can play around with to get the earnings number that they want. But if you look at the revenue, the top line for these banks, it's flat. It's no growth. And that's what investors ought to look for. If the bank isn't growing, the fact that they have earnings up this quarter is more financial engineering than anything else.
Is interest rate help on the way in terms of net margins?
Not immediately. That was certainly part of the story that got everybody so excited last October. But at around the time Donald Trump won the November election, you started to see long-term rates back up. And that was partly because he was talking about tax cuts and spending increases and infrastructure and all this stuff. So financials ran 30%. But did their earnings go up 30%? No. They would be lucky to see 3 to 5% earnings growth this quarter. And what's happening now is that we're giving back those gains that were really predicated on the election of Trump and some assumptions about interest rates. But remember, it takes a bank 5, 6 years to roll their balance sheet. The average life of a big bank is around that duration. So every year they roll off 10, 15% of their assets, and then they can go out and buy new securities, make new loans, and maybe make a little bit more money if pricing goes up. But you got to realize competition for assets today, especially commercial loans, is intense. When I wrote a blog on the Institutional Risk Analyst last week and told everybody that the gross spread on Citibank's commercial loan book was 1.6%, it was pretty horrifying. I mean, that's half of Wells Fargo. And it just shows you that the guys at Citibank are desperate to put assets on their book. And it's really competitive out there. The banks are competing with insurance companies. They're competing with funds, all of whom are looking for assets. So the pricing of commercial loans, commercial real estate has gotten very, very competitive, and it's forced the yields down for banks. So you're going to have to see interest rates go up a lot before you're going to see meaningful lift in net interest margins for banks. And the other thing to keep in mind is that long rates are falling. Investors want to buy those bonds. And Janet Yellen is pushing up short-term rates, so the curve is flattening. And I hope that doesn't continue. My anticipation is it will, though.
Okay, Chris, I want to touch on a different topic before we get to the auto industry. Last time you were on the show, we talked about residential real estate. In particular, we talked about your hometown, where you are now, New York. And you told me at that point that if you drill down into down to the individual home, which you can do, 40% were trending downward at the time. This was back in September.
That's right.
So if you don't look at averages, you sort of break it down. So you're not looking at these big aggregates anymore. 40%. Can you give me an update on that?
Yes, that data comes from Weiss Residential Research. I'm on the board. Alan Weiss is one of the founders of Case-Shiller. And the Case-Shiller index goes down to the zip code, as you said. His new product, though, goes down to the house. And so what he does every month is he tracks homes that are going up, homes that are stable, and homes that are going down. And what you see in the coastal markets particularly is that the number of homes going up in value is falling rather dramatically. A lot of homes that are stable and a growing number of homes that are falling. Those are what we call the canaries, the inferior assets that, it's a nice house, but it's not as attractive as some of the other houses in the area. So sellers have to work harder. They have to be more aggressive in pricing. They tend to fall first. So it's like a school of fish. The school turns slowly. It could take months or even up to a year to see a real change in pricing. And the only thing that's saving many markets, especially out west, is that there's not a lot of new construction. So the limit for pricing is that there's just no supply. Most of my loan officer friends in the mortgage business have 20 completely validated applicants for every house they have. So the question is, who do you show the house to? Because it's sad, because these people want to buy a home. And the limit on bank lending for construction and development has put a real cap on home building in the U.S., and I hope that changes. But there was such devastation during the crisis. $500 billion in construction and development loans held by U.S. banks got written off. And so the pain from that experience, for regulators and bankers is extreme. And they've been very reluctant to do single family, but they put tons of money into multifamily, especially the high-end stuff here in New York City. This city is totally overbuilt. But if you go out to Westchester County, any of those areas, you go out to near in, New Jersey, Long Island, you have home markets that ran okay. They didn't move a lot. It wasn't like California or Dallas. Dallas has been one of the hottest markets in the country. Seattle is another one. Ridiculous. It's been up double digits every year for the past 6 years. And it hasn't slowed down. Seattle is Amazon, a couple of other big corporates are there. They're building both multifamily and other types of office buildings, everything else there. It's a big boom out in the West.
Regarding Seattle, I had a friend visiting from Vancouver just this weekend, and he said that when the local government put the transaction tax on foreign buyers, Seattle got a bump. Have you seen anything that reflects that observation?
I can't validate that specifically, but I will tell you it's a very hot market. I talked to a lot of lenders in that market, both on the mortgage side and commercial banks, and it's one of the fastest growing markets in the U.S. right now. And in fact, the West Coast generally, the growth rates there are much higher than the East. The East is relatively stagnant. Population, if anything, is leaving states like Connecticut, New York. And where is it going? It's going down south. It's going out to the west. Not so much California, because California is very expensive. But Washington, Oregon, Colorado, Texas. I mean, half the mortgage industry is going to move to Texas from California in the next couple of years because they just can't afford to stay there. You have really good people in California in that business, but unless you're servicing distressed loans, you can't afford to keep them there. They got to go to Plano, which is becoming, the biggest mortgage center in the United States now.
Very interesting. Regarding the New York multifamily situation, I had read last year that owners were using concessions. They didn't want to, move the rent, but they were using certain types of concessions to entice renters. Is that still happening, or has it moved on to actual price reductions?
Well, in the rental market, yes. You're seeing new construction that was built for rent where they're having to use pretty aggressive concessions. In the purchase market for really high-end apartments, it kind of depends who the buyer is. You'll have foreign buyers, for example, who work with, my wife. She's a wealth manager. They're buying the asset for 5-10 years as much as a currency hedge as an investment. And they rent the apartment, and if it doesn't generate positive cash, that's okay, because they are wealthy enough that it doesn't matter. Generally speaking, though, if you look at real estate, multifamily, single family, it doesn't matter what it is, if the asset is so high in price that you can't rent it and cover the costs, that tends to be a limit on appreciation. However, you've seen so much foreign money coming in New York that these people are priced indifferent. They're hiding money from somewhere else. Maybe it's even money that they stole. Chinese Communist Party cadres, for example. They send money to this country just to get it out of their own country because they don't trust their government. So the dynamic in New York right now is that we're awash in rental properties, high-end, even down to kind of what you would call the mid to high-end. And it's only going to get worse because of the construction boom we had. We're awash in hotel rooms. There are so many new hotel rooms in this town, over in Queens, even in Brooklyn, for God's sake. They're building hotels everywhere, close in New Jersey. So that's another issue. And again, it was tax abatement, all sorts of policies that were put in place after 9/11. Well, it took 5-6 years to build those buildings, and they're continuing. So the very high end especially is a wash, Albert. I mean, there's so much oversupply. There's so many projects that aren't done. The West Side, down by the rail yards, down in the 20s, all of that is going to add capacity. And the commercial side, office buildings, my God, we are just awash in inventory. And a lot of it's being hidden by the owners. They literally take the space off the market and they don't show it. They pretend it's not there.
Oh, this will be an interesting trend to follow.
Well, look,
Chris.
This is what Janet Yellen wanted. They manipulated asset prices. We had a boom in oil. We had a boom in other commodities. We certainly had a boom in commercial real estate. And it's like a pendulum. Last time was residential. This time, resi went up because of a supply constraint, not because of new construction. And, the financing was there, but the underwriting is very tight in resi now. But commercial went crazy. Absolutely crazy. You had a boom in asset-backed securities with commercial assets, inside them. That's been going on for years. It's going to quiet down now. In fact, next year, the year after, in the ABS market for commercial, it's going to be very quiet because 10 years ago, right after the crisis, there were no deals. So there's not going to be that refinancing activity. You'll still have new deals, but I think it's going to be a lot quieter. Ironically, the resi market is seeing a sharp decline in volume from refinancings just disappearing. And so they're opening the credit box. And now we're going to see more tolerance for lower FICO scores from borrowers. You're going to see more jumbo product coming to market and being securitized, which we haven't seen for the past couple of years. So it's very interesting, the ebb and flow between these two markets.
Chris, let's pivot over to the auto industry and then talk about your new book. What's going on?
From the sublime to the ridiculous.
Exactly. What's going on in the auto industry?
Well, again, Chair Yellen wanted to increase consumption. And so by dropping interest rates the way that they did, buying assets and changing the risk curve in the bond market, they created a boom in auto finance. Also, there was a lot of capacity on Wall Street, and they couldn't do residential mortgages, so all of that capacity focused on auto loans. We've seen a doubling in the total body of both leases and loans for cars, prime, below prime. And, the key metric you got to keep in mind is at the time of the crisis, leases were like single digits.
Looks like I've lost Chris temporarily. Try to get him back. Chris, can you hear me?
In fact, Ford and Chrysler just came out with their numbers, and they were awful, which shows you that we were in a boom thanks to the Fed. The boom is over. You're going to see higher default rates, and people like CarMax, who buy cars from the automakers and then turn around and lease them, they're going to be taking the hit when those cars come back. Because if there's a car that's supposed to be worth $22,000 at the end of the lease, but the bid is $16,000, CarMax takes the hit on that because they own that portfolio. And you're going to see the big automakers taking hits on their captives. You're going to see, I think, some below prime players disappear. And that shrinkage in the credit available for the auto sector is going to cause sales to fall. You're already seeing GM with the incentives, crazy. But these are very cyclical businesses, and they got to keep their doors open. And the way they do that is by just continuing to move the product out the door, no matter what the economics are. They worry about that tomorrow. So it's a boom and a bust. We talk about this in my new book, but nothing's changed. I had to laugh when David Einhorn came out and he wanted to split the common equity of General Motors. And I'm like, what are you talking about? You can't do that because you don't know what next year's cash flow is going to be. There's no visibility with these companies.
Give us a time frame, Chris. When do you expect some of these things to start showing up in a big way?
Well, the defaults you can see now, not so much in prime paper. The bank portfolio of auto loans is actually pretty quiet, but certainly the below prime paper has been showing increases in defaults for a while. The bonds themselves in these ABS deals, asset-backed securities deals, are fine because they tend to be over-collateralized very heavily. So for every dollar in auto loans that they securitize, they typically sell 50 cents worth of bonds. So you could have a lot of defaults and the bondholders will get paid. But for the companies that lease these things to consumers, they sell cars to auto rental companies and things like that, the economics of this business are getting very, very challenging. And my sense is you're going to see red ink coming from Ford, GM, Chrysler this year, and it'll probably get worse next year because we did 18 million units in 2016. We'll be lucky to do 16 this year, be my guess, maybe lower. And so that boom we saw after the crisis, and it went on for 5 years. Auto sales just climbed straight up into the sky. It is over. We're probably going to normalize somewhere around 15 to 16 million units, which is okay, but it's not as bright a picture as what we saw last year. Definitely not.
Okay, let's talk about the book Ford Men. You talk about Henry Ford and the family as well.
Yes.
Why did you write this book?
Well, I started working on this book about 12 years ago. Technically, it's my first book. But I didn't have a happy ending because Bill was taking over the company. Jacques Nasser had left. I met Nasser when I was working at Bear Stearns. And the whole industry had been through this mess of the dot-com bubble. And, they were innovating and they thought they could get rid of their capital-intensive businesses, which is complete nonsense. So what really got me into this was two things. One, I had been a stringer for the Washington Times, and I had done a series of articles about the Ford Explorer and the Firestone tires, which was a mess. It was not good for Ford. Did a lot of damage to the company's brand. But I was also, being a student of the Depression, I'd always been fascinated by the role of Henry Ford in the early 1930s, because he actually made the Great Depression much worse. He threatened to take all his money out of the bank in early 1933, before FDR took office. Remember, in those days, you had a long period from the election to the inauguration. It was over 5 months. The president didn't take office until March. So Herbert Hoover was talking to him and his former business partner, James Couzens, and they're trying to rationalize with him and say, look, you got to support the banks in Detroit. You can't take your money out. But he didn't care. Henry Ford was a very selfish and in many ways myopic man who took his own advice and really didn't care that much about other people. And so he threatened to do this. The governor of Michigan finds out and closes all the banks in Michigan. That causes a ripple effect. So by the time FDR takes office in March of 1933, all the banks in the United States are closed. And the banks in Michigan stayed closed for months. That's because of Henry Ford. And, to his credit, Edsel Ford was just the opposite. Edsel was a very intelligent, caring man who was supporting a couple of the Detroit banks with his own money. And he was actually at loggerheads with his father. But I just thought, it was so fascinating that Ford could have played such a huge role in those terrible years, and yet we never talk about it. And the reason we never talk about it is because the public relations function at Ford has airbrushed the history. And they've kind of gotten rid of some of the details. So the whole point of Ford Men is to remind everybody of the biographers and the journalists who covered this story for many, many decades, and to just remind everybody about some of the detail, the relationship between Ford and James Couzens. Couzens is the guy, to the subtitle of the book, who turned it from inspiration to enterprise. If it hadn't been for James Couzens, there wouldn't be a Ford Motor Company today. Henry didn't invent the assembly line. That was Charles Sorensen, the great Danish engineer who ran Ford for 40 years. We never talk about him. So there's a lot of little sub-stories in the book. I treat Edsel very well. Edsel was probably the only Ford who knew how to make cars, seriously, in terms of a manufacturing know-how sort of sensibility. And then Henry Ford II, one of the great heroes of the story, saved the company after World War II. Because, Ford was lucky to survive the first 50 years because of Henry. He drove all the good people out. He ran the company like a plantation on cash. There were no financial records. So when the family finally took it over after his death, they had to basically rebuild the whole company. And Henry Ford II deserves enormous credit for that.
Chris, this is a fascinating story, and it's familiar, but it is very interesting. I think the public gravitates towards these strong, interesting figures. And so from a PR standpoint, it makes sense to throw him out there. There's a quote that you mentioned early in the book. It says, you can't build a reputation on what you're going to do. He's famous for many of these quotes. I would like to see that one hanging at Tesla headquarters, actually. I think it'd be very beneficial for everyone. But he is known for these quotes. But in the story, you talked about James Couzens, for example, who actually ran the company. I see parallels to both Steve Jobs and also Bill Gates, and specifically here, Bill Gates and Paul Allen. Is that something that stands out to you, where there's a figure who is central but who is less known?
Well, I think that's a great observation, Albert, but particularly the Steve Jobs comparison with Henry Ford is very apt. Because, Steve Jobs was successful because he was in the right place at the right time when technology was changing. Henry Ford the same way. If Henry Ford hadn't been there, the Dodge brothers would have done it. Other figures in that Detroit community would have put a motor on a wagon. That's what a car is. If you look at a pickup truck today, that is the lineal descendant of a wagon. And I think that the impact of luck, the impact of association and just bringing people together is consistent in the Microsoft story, it's consistent in the Apple story, and very much a part of the Ford story. Because the thing is that, we tend to deify successful people, leaders in our society. We tend to blow them up to enormous scale. And Henry Ford was a huge figure. He was probably one of the most important figures in the first half of the 20th century. But I'll tell you something, if he had had the personality and the sensibility of his son Edsel, he would have been the dominant figure in the 20th century. There's no question in my mind. Henry Ford was a dysfunctional human being who was not comfortable around people. He rarely spoke in public. He played around with politics a little bit and was always distracted by other things. He wasn't running the company in the last 30 years of his life, definitely not. And, for example, everybody thinks Henry Ford raised wages in the 20s. He didn't do that. That was James Couzens. Couzens was a man who had become enormously wealthy because of a little bit of money he put in the Ford Motor Company. All the investors got their money back in the first year. And then it just went straight up like a rocket. That's how much demand there was for cars. But it was Couzens who was haunted by his wealth, saw all the poverty around him in the 20s and the 30s in Detroit, which was considerable. And he was the one who advanced the idea to raise wages because then they could buy cars. Henry's inspiration was to make the product cheap and to make it affordable to everyone. But unfortunately, that also meant that Ford only ever dominated the entry-level car, and they never had products at the mid-price and the upper price to compete with General Motors. So by the time you get to the late 30s, people compared Ford to Chevrolet. They didn't even compare Ford to General Motors, because General Motors was the biggest corporation on earth, and they were run by Alfred Sloan, the great genius of management, who understood leverage. Ford still wouldn't lend you money to buy the car. It was cash on the barrelhead, whereas Sloan realized that if I finance sales, I finance my inputs, I don't need any capital. There was no working capital at GM. That was his brilliance. So,
Chris, I want to bring out something else that stands out to me. So we underestimate the value of collaboration. So Paul Allen to Bill Gates, James Cousins to Henry Ford. But we also undervalue or underappreciate the value of competition. And here's where Henry Ford, to me, looks a lot like Steve Jobs. Steve Jobs said iPods are white, for example. iPhones are this form factor. Who's going to want to hold a big phone? Eventually, they conceded, right, with pressure from Samsung. They make the big phones. Henry Ford, cars are black, and the chassis is fixed, and we're not going to customize them. Meanwhile, I think it was GM was doing that and having great success. Eventually, he changed his mind about that and permitted it on the assembly line. Do you agree with that, or do you have anything to add?
Well, I think that's a very apt comparison. Brilliant people, and people in general, tend to sometimes have blind spots. And the blind spot with Henry was he believed that the Model T was perfect, and he kept taking cost out of it in order to maintain their market share. He built the same car for a quarter of a century. If you think of it, when they started with the Model T, the Wright brothers were just getting off the ground at Kitty Hawk. In 1927, when they stopped making it, Motorola was making radios. So think of the change that happened in the U.S. economy over that quarter century. But he had a blind spot in terms of understanding consumer wants and needs. So, for example, the Model T it was very stripped down, and they wouldn't offer people add-ons at the point of sale. You had to buy stuff out of the Sears catalog to plug into your Model T. It was the single biggest component of the Sears catalog in that period. Eventually, they allowed people to buy one with a flatbed, so it was a truck. But it took them years to figure that out because Henry Ford refused to let his engineers make changes. So, comparing it to Steve Jobs is very interesting because, again, brilliant inspiration, kind of sort of knew what he wanted to do, but wasn't flexible enough to take input from other people and basically make the product better by listening to your customers. Your customers will always tell you what they want. You just have to listen. That's something I've learned working in financial analytics. Whenever we built a website or when my partner Dennis Santiago and I built our bank analytics product years ago, the customers would tell you, oh no, this peer group is wrong. You should have so-and-so in that peer group for this bank. You just have to listen.
Agreed. Very interesting conversation, Chris. We're running out of time, unfortunately, but I look forward to taking this up with you another time. Thank you very much for sending me that book. I'm enjoying it very much. Please, guys, April 11th is a launch, but you can get it through Amazon on pre-order with a price guarantee, I noticed. So that's Ford Men by Chris
Whalen. If you come to Vancouver, I'll sign it for you.
Exactly. Come to doing my job for me. I like that. July 25th, Vancouver Symposium on Natural Resources, naturalresourcesymposium.com. Chris Whalen is going to be a featured speaker there. Sign up now, save hundreds of dollars, and get your free MP3 download. My guest has been Chris Whalen. His website, rcwhalen.com. Chris, thank you once again for joining me on the Power and Market Report. It's always a pleasure.
Hey, thank you. I'll see you in a couple months.
See you soon.